All right, let's dive in. We're going to cut through the noise, the numbers, all the jargon today. We're digging into the latest weekly market brief to really pull out those crucial insights you need, you know, to get a proper handle on the global economic landscape and what's actually driving it.
Exactly. And for this analysis, we'll really try to unravel the key decisions from central banks, especially the Fed. We'll explore the impact, immediate and broader, on global markets. And crucially, look at the important data coming up that, frankly, everyone's going to be watching.
Okay, let's start right there then. The big news from last week. The Federal Reserve, their interest rate decision. What exactly was the move?
Well, the Fed decided to keep interest rates on hold. They kept them in that 4.25 to 4.50% range. It was pretty widely anticipated, actually.
Yay, holding steady. But the real story is often in the details, isn't it? Those updated economic projections they released. What do they tell us about the U.S. outlook?
Yeah, absolutely. The revised projections, well, they painted a slightly more challenging picture, you could say. They actually revised growth expectations a bit lower,
Lower growth. Okay.
and at the same time nudged inflation forecasts slightly higher.
Higher inflation, so kind of the opposite of what you'd want to see.
Exactly. And what's critical here, the nuance, is that this inflation adjustment was largely put down to the expected impact of tariffs.
Ah, tariff, so more supply side pressure.
Precisely. And that's significant because, that kind of inflation is much tougher to fight with just interest rate tools. It could mean rates stay higher for longer than maybe the market hopes.
Okay, and speaking of those projections, the median dot, that always gets so much attention, where each official thinks rates are heading. What did that signal? And I heard there was some surprising division within the committee.
Well, yeah, the median dot itself, it still points towards 2 rate cuts before the end of the year. But, and this is the interesting part, the committee is definitely more divided than it was before.
More divided. How so?
We're seeing a growing number of members who now expect no cuts at all this year.
None at all. Wow.
Yeah, it suggests quite a split in their thinking right now.
That division sounds pretty significant. What's driving that split, do you think? Is it different reads on the data or maybe a more philosophical disagreement on easing policy?
I think it's probably a bit of both, really. Some members are likely more worried about inflation sticking around, the labor market maybe being too tight still. They want to see really clear proof that inflation is heading back to that 2% target sustainably.
Okay, the inflation hawks.
Right. And then others might be looking more at the risk of an economic slowdown, or perhaps they think policy is already tight enough. So it really reflects a genuine internal debate about the best path forward, not a solid consensus.
Right, a real debate. So given this cautious stance, this internal discussion, what was the overall tone from Chair Powell in the press conference afterwards?
Powell came across as notably careful, very measured. He kept stressing that their policy moves are completely tied to the incoming data, data dependent. He did acknowledge progress on inflation, said things are moving in the right direction, but he also made sure to highlight that risks still remain, especially from external shocks, things outside the Fed's direct control.
Okay. Cautious and data dependent. So boiling it all down, what does this mean for you, our listener? What's the key takeaway from last week's Fed meeting?
The core message, I think, is pretty clear. The Fed is in absolutely no rush to ease monetary policy. Just no rush at all. I mean, you've got inflation still above their target, and the labor markets, yeah, they're cooling, but they're certainly not collapsing. So they're basically exercising significant patience right now.
Okay, no rush to ease. But, you look at some parts of the market, and they seem to be pricing in cuts sooner rather than later. How do you square that? Is it just investors getting ahead of themselves?
That's a great point, and it really highlights that tension we often see. Investors, well, they always try to anticipate the Fed's next move, right? Sometimes they get a little optimistic.
Sure.
But the Fed's own messaging, Powell's tone, it tells us they're being much more data-dependent, much more risk-averse at this moment.
Yeah.
The market might be looking further out, maybe 6, 12 months. The Fed seems focused squarely on the current inflation and labor data.
Yeah.
And that disconnect, well, that's exactly what can create market volatility.
Yeah.
And maybe opportunities, too.
Right. And you mentioned risks. This brings up an important question. What are those conflicting risks the Fed is juggling that are leading to this caution?
Well, if we look at the FOMC's own risk weighting, it shows just how complex things are. This is based on data as of June 19th, by the way. For things like real GDP and core PCE inflation, readings above 0 mean they see upside risks.
Meaning growth or inflation could come in hotter than expected.
Exactly. Which could force them to keep rates higher for longer or maybe even hike again, though that seems unlikely right now. Conversely, readings below zero signal downside risks.
So concerns about a sharper slowdown or inflation falling faster.
Precisely. Which could, open the door for rate cuts sooner. It just shows that tricky balancing act they're performing constantly.
Okay, a real tightrope walk. So given that cautious, data-dependent stance, the market's focus obviously shifts straight to the economic calendar. What are the really crucial indicators coming out this week that could either, support the Fed's view or maybe challenge it?
Yeah, this week has several really critical data points that everyone will be watching closely for clues. So on Monday, we get the composite PMIs for June. These are important early reads on economic activity. We'll see them for the Eurozone. The prior was 50.2. Japan, also 50.2. The UK, that was 50.3. And the US, which was stronger at 53.0 previously.
Right. Those PMIs give a good snapshot across manufacturing and services.
They really do. They offer an early feel for global growth momentum. Then Tuesday, we get U.S. consumer confidence for June. The prior reading was 98.0.
Consumer confidence, always a big one for gauging future spending.
Absolutely. It's a powerful gauge of consumers' willingness to spend, especially on bigger ticket items. If confidence drops significantly, we often see spending tighten up a few months later.
Yeah.
That directly hits economic growth.
Okay, so PMI's Monday, confidence Tuesday. What else?
Friday is the really heavy day, particularly for U.S. data watchers. We'll get Japan's retail sales for May 1st. That was up 0.5% month-on-month last time. But for the U.S., the big one is core PCE inflation year over year for May. The prior was 2.5%.
Core PCE, the Fed's preferred inflation measure. That's key.
The absolute key one for them, yes. And alongside that, we also get personal income for May. Prior was 0.8% month-on-month, and personal spending, which was 0.2% previously. Those income and spending figures obviously tell us a lot about the health of consumer demand, which is, the engine of the U.S. economy.
Okay, quite a week for data then. So these are the numbers we'll be watching for clues about the future. But stepping back, how have global markets already been reacting to this whole economic picture we've discussed? Let's zoom out a bit. What's the overall scene for equities?
Well, looking at the broad global picture, the MSCI All-Country World Index, it was actually down slightly, about -0.2% a week ago. But context is important. It's still up a decent 3.9% year-to-date.
Okay.
And compared to a year ago, it's up a pretty robust 10.5%. So maybe a little pause recently, but the overall momentum for the year has been quite strong.
A recent pause, but strong year-to-date. Were there any particular regions or sectors really standing out, either doing remarkably well or maybe struggling?
Yes, definitely some interesting divergences. What's quite striking is the strength we've seen in some European equity markets. For instance, the IBX in Spain, that's up an impressive 22.1% year-to-date.
Wow, over 20%.
Yeah, and the FTSE ID in Italy, up 18.4%. Germany's DAX also strong, up 17.3% year-to-date.
So Europe's been a bright spot. Why do you think that is? Better sentiment, valuations?
It's likely a combination. Maybe improving economic sentiment there, perhaps catching up after lagging a bit, and possibly more attractive valuations earlier in the year played a role. But on the flip side, globally, some sectors have been underperforming year-to-date. Consumer discretionary, for example, is down -4.5%. 4.5%.
Suggest maybe some consumer worries.
Could be. And healthcare is also down a -2.9% year-to-date. So it suggests investors are getting perhaps a bit more selective, maybe pulling back from some growth-sensitive areas or even defensives like healthcare in this case. Meanwhile, technology, that was up 0.9% just a week ago, and it's up 1.9% year-to-date. And financials, up 0.5% a week ago, and a strong 9.5% year-to-date.
Okay, tech holding up, financials doing well, possibly helped by rates.
That's a reasonable assumption for financials, yeah. Show some resilience there.
Got it. What about bonds and commodities? How have they fared amidst all this?
Right. In the bond market, the U.S. 10-year Treasury yield was sitting around 4.38%. That's actually down 3 basis points a week ago and down 19 basis points since the start of the year.
Yields down slightly. Suggests some caution.
It does. Reflects that cautious tone, maybe a bit of flight to safety. Over in Europe, Germany's 10-year yield was at 2.52%, also down slightly a week ago by 2 basis points. But interestingly, it's still up 15 basis points year to date. So a bit of a different trajectory there compared to the U.S. this year.
Okay. And commodities. Oil and gold.
Oil, Brent crude, actually saw a decent jump. It rose to $79 per barrel. That was up 5.9% just a week ago, and it's up 5.4% year to date, likely reflecting ongoing supply concerns, geopolitical factors perhaps.
Right.
Gold, however, dipped slightly, down negative 1.7% a week ago, but don't let that fool you. It remains a, frankly, remarkably strong performer this year. It's up 28.3% year to date.
28%.
Yeah, and even more impressive, up 42.8% compared to a year ago. Really highlights its role as a safe haven and, an inflation hedge when things feel uncertain.
Absolutely staggering gains for gold. Okay, what about currencies? Any notable shifts there?
Yes, a few key levels to note. The dollar per euro rate stood at 1.15. The yen per dollar, that was at 146. Now that's up from 144 a week ago, meaning the yen weakened a bit recently against the dollar. But it's significantly stronger compared to earlier levels this year, like 157 and 159 a year ago. So perhaps those Bank of Japan policy shifts are starting to have some lasting effect there, despite the recent dip.
Interesting. And the VIX, the fear gauge.
Ah, yes, the VIX, it stood at 21. Now that was unchanged week over week, but it's definitely higher than where it started the year, which was around 17. And it's way up from 13 a year ago.
So volatility expectations are up significantly over the year.
Definitely signals a measurable increase in market apprehension. An expectation for bigger price swings ahead. It directly reflects all this uncertainty we've been discussing.
Right, it all ties together. So pulling back again, what does this all mean for the broader health check of global economies? Let's do a quick run-through of the latest GDP and CPI figures for the major players.
Sure, a quick snapshot of the macro health. For the U.S., latest GDP was actually negative 0.2%, with CPI inflation at 2.4%.
U.S. GDP negative.
Yeah. The Eurozone saw GDP growth of 2.5%, and their CPI was lower at 1.9%.
Better growth in the Eurozone, lower inflation.
Right. The U.K. had GDP at 2.9%, so also decent growth, but their CPI was higher at 3.4%. Japan, like the U.S., recorded negative GDP, also negative 0.2%. but with higher inflation at 3.5%.
Japan also contracting.
And finally, China. GDP growth was strong at 4.9%, but interestingly, their CPI was negative at negative 0.1%, deflationary pressure there.
Those negative GDP figures for the U.S. and Japan really stand out, don't they? And China's negative CPI? What's the practical takeaway from these big contrasts?
Well, it really highlights just how different the economic paths are for these major regions right now.
Yeah.
You've got actual economic contraction in the U.S. and Japan that puts real pressure on their central banks.
Sure does.
Then China's negative CPI, that deflationary pressure, it means consumer prices are falling. That can actually be pretty bad for growth because people tend to delay purchases hoping prices will fall further.
Right, a deflationary spiral risk.
Exactly. So these divergences mean central banks globally aren't just reacting to the same global trends, they're wrestling with very unique domestic challenges too.
Makes sense. And finally, just a quick glance at market valuations. Where do things stand?
Yeah, briefly on valuations, the forward price-to-earnings ratio, or PE, for the S&P 500 is currently sitting at 21.5. And for the broader MSCI World Index, it's 19.2.
How does that compare historically? Relatively high?
Yes, relatively high compared to long-term historical averages. It suggests investors are, let's say, pricing in some pretty robust future earnings growth, which, leaves less room for error if companies don't deliver on those earnings, makes the market potentially more sensitive to any negative news or disappointments.
Right, less margin for safety there. Okay, this has been a really insightful breakdown. It truly highlights that cautious, data-dependent path the Fed is walking, and just the incredible diversity in what we're seeing across global markets. Strong equities in some places, negative GDP in others, inflation worries here, deflation worries there. It's a really complex picture.
It absolutely is. And understanding how all these interconnected economic indicators fit together, that's really the key to grasping the bigger market narrative. It's not just about, what one central bank does in isolation, but how those actions ripple through different economies, different markets, often with quite unexpected consequences.
Absolutely. So here's something to think about, a final thought for you, our listener. Given these really mixed signals we're seeing globally, some economies contracting, others seeing strong equity gains, persistent inflation here, deflation there, what do you think might be the next big unexpected turn in this global economic story? Something to really chew on.
That's a great question to ponder. And I'd really encourage you to keep following the data very closely, especially those upcoming releases we talked about, the U.S. core PCE, the composite PMIs. They really do offer crucial clues about where things might be heading next, and they'll definitely be shaping market sentiment in the coming weeks.
Definitely. Keep digging, keep learning, and join us next time for more deep dives into the insights shaping our world.